So, good evening, everyone. Welcome to today's class. So, we are continuing from where we stopped, group accounts, and we have been able to look at so many adjustments. I think yesterday we were able to look at intergroup sales, both sales of inventory and transfer of assets. Abi, I will also look at the intergroup loan, and we discuss fair value adjustment. So today, I want to practicalize some questions that cover those three adjustments. For both fair value adjustments, example on page 34. Example on page 34. Yeah, let me get it. On page 34. Example 1, fair value adjustment and depreciation. The statement of financial position of H Limited as of December 2012 is shown below. Non-current assets, property, plant and equipment, long-term investment 210 shares in X Limited. Then current asset inventory 80,000 and 7,000 for subsidiary, receivable, bank, cash, equity and liability, ordinary share of 50 kobo each, retained earnings, current liability, payable, and taxation. So that's the financial statement of that entity. Then you were informed that is actual information now. 1. H Limited purchased its shares in X Limited on 34 December 2011 when the balance on retained earnings of X Limited stood at 140,000. That 140,000 represent what? Pre-acquisition retained earnings. Okay. In arriving at the consideration for the share in X Limited, the fixed asset of X Limited were revalued to how much? 500,000. No adjustment was made in the book in respect of this revaluation, and there were no purchase or sales of these assets since acquisition. The director wished to give effect to the revaluation in the consolidated account. That means the asset of subsidiary was actually revalued. I want to tell you was valued to a particular asset to amount 500,000. Abi, and they said this adjustment has never been reflected in the books of the subsidiaries. That means before you consolidate, we must what? We must reflect it. And I made mention something yesterday that any revaluation surplus, as at the day we acquire subsidiary, is part of what you are paying for. Abi, so it's pre-acquisition event, not post. So it's part of what you are paying for. So you must calculate it as inclusive for your net asset acquired after that day you acquire. So we have to look for that surplus. Then number 3, the depreciation figure for tangible assets at 31 December 2012 and after provide depreciation for the relevant year on the books of book value at the beginning of the year. How is the rate? 12.5%. You are required prepare consolidated statement of financial position as at 31 December 2012. So I'm looking at all these adjustments now. So in this question, no, I said you have to maintain a position. What's that position? That you must be able to identify the number of adjustments in your question. Abi, so in this question now, the only adjustment that we have here now is what? Is what? It's only what? Revaluation, fair value adjustment. I mean, that's only what we have in this question now. So let's particularize now. Let's get our workings out and let's try to particularize. This question is somehow unique, somehow. And why it's unique, I will explain it better. Now, our workings. Workings 1 is our what? Group what? Group structure. Might not be placed. Now, in this group structure, how many shares or what is the control of subsidiary in parent here? This question, they didn't give us especially, but we were told they give us the number of shares that parent acquired. You can see that one in the financial statement, Abi. Long-term investment, 210 shares in X Limited, Abi. That means that will be parent acquired 210,000 shares. The question is, what is the total number of shares of subsidiary? The number of shares of subsidiary That will be 150 divided by 50 cover, right? That will give us what? 300 shares. So once you have 300 shares, you enter in there 100%. What do we have now? 70%. Therefore, our NCI divided by 30%. So parent acquire 70, NCI is having 30%. Number 2 is what? Consideration transfer. Abi? Yeah. Consideration transfer. So how much do we pay to acquire subsidiary? I think we pay 350,000. 350,000 to acquire subsidiary. The next thing number 3 is our net assets acquired. Yes, that's where we have a simple workings now. That's the net asset of subsidiary as at the day you acquire. Now, normally, I said you should bring out your ordinary share first, David. Ordinary share. How was ordinary share? That subsidiary, the nominal value. That 150,000, right, David? That 150,000 is the number that comes to 300,000 last time I paid about. So what do you do next? You add your what? Retained earnings. And at this day you acquire, what is the retained earnings for that subsidiary? 140,000, right? 140,000. Now, this is the book value. This is the book value of this company share because we were told that the revaluation surplus that occur has not been reflected. So, and I said, any revaluation surplus that arise at the day you acquire subsidiary is a part of pre. So you must add it to this because that's what you are part of what you are going to pay for. But our challenge here is this. Our challenge is this. Let's go to the question. In arriving, that's the question number 2 now. In arriving at the consideration for the share in X Limited, the fixed asset of X Limited were revalued to 500,000. Full stop, Abi. No adjustment was made in the book in respect of this revaluation, and there were no purchase or sales of this asset since when acquisition. Look at something now. When did we acquire? We acquired in December 2011, Abi. When are we consolidating? 2012. That's just 1 year. So if we acquire, I want to try to estimate my value of money now. Estimate the revaluation surplus. Now, we acquire on 31st December 2011, Abi, and we are consolidating on when? 31st 12, 2012. Am I talking now? Now, in this question, the fixed asset in the question, how much is it? The fixed asset in the question. That's the property plant request was what? 306,000. I mean 306 and what? 250. Now, these are the book value that is kind of amount. And we're told that as at this date, this asset has been revalued as at this date. What is revalued? This asset has been valued to how much? To 500,000. To 500,000. Asset has valued to 500,000. But as at that date, we did not reflect it in our figure. Am I talking now? Yes. Reflected. Then we have now depreciated this value to this value. Check, are you enjoying now? Okay, I want to look at number 3 question. Okay, my 3 information now. The depreciation figure for the tangible asset as at 31 December 2012 are after providing for depreciation for the relevant year on the book value. That is, what the depreciation is not on this figure. Because watching it, it's on this figure. So when you check this figure like this, then you have this now. The question is, what was that figure that they depreciate to get this figure? Can you tell me now? So that means you have to get the value here before depreciation. And our depreciation is how many percent? 12.5% Abi of this. Abi, this and the Abi. Now, 12.5% of this figure, Abi, is give you depreciation, right? But we don't know this figure now. So that means you can interpret it mathematically. If you like, you can say, if this one is X, That means our depreciation, you know what, 12.5% of X is your depreciation, and for you to now get this figure now, come on, get depreciation minus X, so you better mean I can say X minus 12.5% of X, is not to what? It's not to 306 250, then what's your X now mathematically? You work it out. Yeah. This time this one for 12.5%, you just convert it to one. Yeah. Anyway, you press it. Is that correct? Just press the 12.5%. 12.5% is one for 0.25. So that's this one will become 0.125x, then minus x, then this and this to that side. 0.875x, is equal to 306 250, that was like 0.875. 0.875, our x is equal to what? 350,000. That means the figure here should be what? Should be 350,000 before depreciation. That's what I did now. That's why I say this figure is somehow technical somehow. So now, if this is 350 figure, as a day we acquire, and we say we are value zero, how would I value surplus now? Yes, 150,000. That's our value surplus. So our fair value adjustments, that's how much now? That will be 500 valuation surplus and as well 350. The value of the asset before depreciation, 150,000. So you can logic now. So therefore, our asset acquire, you know about the asset acquire, yeah, together.
40,000.
40,000. That will be the net asset acquired and the day price subsidiary. Now, I made some mention on yesterday that the moment there's a valuation surplus on at acquisition date, once the asset is a depreciable asset, you must calculate what? Under depreciation. You must calculate what? Under depreciation. So it's very easy. You can now let's say movements, don't do like this. Movements in fair value adjustments at acquisition date, accumulated depreciation, then at consolidated dates. Now, so what's the name of the asset? Property, plant, and what? Equipment. How much is the value that we are looking for? 150,000. Then, what are the division rates? 12.5. So 12.5% of this figure.
18,750.
That will be 12.5% of 150. That will be our annual depreciation. 18,750. Then I asked that when do we acquire? We acquire 2011. When I was relating, how many years that? 1 year. That we only claim 1 year depreciation. So we put it here. That will be 18,750. How you subtract from this figure? What do you have?
131,250. 131,250.
131,250. So that's the figure. So how do you proceed now? This is the figure now. This figure now, you add it to your work, to your PBE, where you are consolidating. And this one, what do you do? Subtract from your work, from your retained earnings. So you debit your retained earnings to 80,750, and you debit your asset to what? 1,250. That is the procedure for that. So in this question, our challenge is that nobody give us the word, the fair value adjustment. That's why we have issue. Now how we do it is very easy. I say, just make sure that you turn the number back to after that day. Please, some question. It's possible that you apply in 2011 and you're consolidating when? In 2014 or 13, 2 years after. So you must follow that procedure again. So that means what you have removed the word is 2 year depreciation, right? Before you get this one, so you have to do the mathematically like that.
So it will be
this figure that is 2.
times 2.
I get 12. That Calculate over get 0.125x times 2. Abi, before you now work it out. This is 2 years. Allah, you owe me. You get to so. I go get you. I don't get it. If this one is 2011 now, and this one is 2013, that means I calculated 2 years depreciation. Abi, so that means this is just not 1 year depreciation with 2 years depreciation. So that means that when you are doing your workings now, your depreciation according to the workings now is 0.125x is your depreciation. So times 2. We might get this times 2 now before you now work and work it back. That's your depreciation. So have we done that? Calculate our NCI. Bó ti jẹ́ gan-an. Owó ọmọ àwọn pé mo kó àgbọn kíláàsì. So number four now, our NCI at amputation date. Sorry, not amputation date. Our NCI total. Then NCI now, and I will go that please. NCI so at acquisition date. So in this question, how do we get our NCI? Is that fair value? Yeah, is that fair value? Our portion is Abi.
Yes.
So what do we do now? Calculate the how many percent?
30%.
So 30% of 440,000, right?
Yes.
So our NCI will be, since our portion will be 30% of 440,000, right? We have
132,000.
132,000. So that number 5 now. That's our what? Our goodwill. Our goodwill. So what do we do first? Consider transfer. Mr. Tayo, consider transfer. You look there, 350 Abi, 350. Abi, our NCI at the acquisition date, Abi, you look there, 132,000. So in total, 482,000. Then what do we do now? Let's work. Net asset acquire. Net assets acquire. That was 440, Abi. 440,000. So that what we have? 42,000. Goodwill or what?
Goodwill.
Goodwill. Okay. Goodwill. Goodwill. Always going now. So once we get our goodwill, what next? We try to get calculate our post acquisition repayment of the subsidiary. So number 6 now. Number 6, post acquisition retain earnings of X, Abi. So as a financial position now, as per financial position, I told you that you go through to financial position and you put the figure. That figure there is what? Is for both pre and what? And post. And since we are looking for post, we just remove the pre, Abi, from it. So yeah, what is the figure in question? 251,500. What do we do now? Less pre retain earnings, Abi. We less retain earnings. How that retain earnings? 140,000. 140,000. We less it. Don't forget, I said your fair value adjustment, your under depreciation on it. Abi, what do you do now? You get it your profit loss account with that. That would be under depreciation on the fair value adjustment. You look at 18,750. So that how is it called? No other information again. How do we have 92,750. So this is the profit that belongs to subsidiary that we share between parent and let's share it now. Share between parents and the subsidiary. That will be 70% and what? And 30%. Have you correct? So yeah. That will share of post acquisition retain earnings of X. Abi?
Yes.
27,825. Abi? That in total. In total. 159,825. So in the view of that, our last work is what number was? Number 7. So our work is number 7. Have our consolidated retained earnings. I mean, so with that, as per financial position, the figure of parent as per financial position. Where was it?
48,500.
Position
48,500.
48,500. 500, right?
Yeah.
So we quickly give his own share here. Share of post acquisition retained earnings of the X. That means 70% of this, 64,925. So I think in this question, no other adjustment again,
Yes.
no that group says, no nothing. So in view of that, our total retained earnings for parent 313,425. 313,425. So in view of this now, any question? What do we do next? We consolidate. So let's try to make attempt to consolidate. Are we too? Yes. The profit of subsidiary, yes. Not again. The only thing you have to do is that you have to add this onto your assets. You have this balance here to your asset, subtract it off from your retained earnings. So now, who is HRB? H Limited. Yeah, consolidated statements of a financial position as at when? As the 1st December 2012. 2012. Okay, the asset side. Our asset side, we have to look at our property, plant, and equipment. Property, plant, and equipment. Below there? Yeah, which one I was on is page what?
Page 34.
Okay, 34. So it will be, now look at it though. Our property, plant, and equipment for each 300,000, right? Plus subsidiary 306,000.25. Then plus the valuation surplus, the balance, that will be 131. That will be 131.250. Everything now 737,500. Then our long-term investments disappear, right? Then we have to put our goodwill. The goodwill. How much our goodwill for the question? 42,000. We put our goodwill at 42,000. Our total non-current asset, what do we have? 779,500. Have we done that? We go to our current asset side, have we? Our current asset side, current assets. Don't forget, we are adding both parent and subsidiary together. So we have inventory cost. Inventory, the parent own is how much? 80 plus 70. Give us how much? 150,000. Then followed by receivable. For the receivable, we have parent 60 plus 50. That will be 110,000. Then we have a bank.
50 plus 40.
We have 50,000 plus 40,000. That gives us what? 90,000. Then for the cash, we have 30,000 plus 20,000. Give us how much? 50,000. So we have our total non-current assets.
400,000.
That will be 400,000. 400,000. By the time we add them together here, 1,179,500. Our total assets. So we now go to our equity and liability side. So for equity, don't forget, I will repeat again that the equity component of subsidiary will always disappear. We only focus on parent alone. After you have adjusted for the retained earnings of parent. So we have ordinary share for the parent alone, 500,000. 500,000. Then our retained earnings, what that we have adjusted for parents. We have adjusted that our work is number 7. How much? That will be working 7. That will be 313 425. Then having done that, no other utility total.
813.
We have 813 425. Then we have to bring our NCI. That's our what? Work is number what? Number 4. Work is 4. How much do we have there? 159 825. Have you? 159 825. 825. Then we have to consider our liability side. Have you? We have payable. Have you? We have current liability. First one is payable. How much are payable? 100 plus 100 plus 60.75.
160.
That will be 160.
750.
750. Then we now go for our taxation. Have you? Taxation, which is what?
21.5
21.5
plus 24.
plus 24. 21,500. What do we have?
45,500.
45,500. So our total equity and liability altogether. Total equity and liability. That will be 1,179,500.
500.
So that solves the question on how to calculate the fair value adjustment. This question is very, very technical. Why? Because the fair value adjustment was not given to us expressly. So that's where the only issue that we have in this question. And it's very easy to understand if we follow information technically. So away from that,